Hey everyone, we have Marcus from Celo. He'll be doing a talk on design of a sustainable stable asset protocol. And I'll let him take it from here.
Cool. Thanks a lot for the introduction, and thanks everybody for dialing in. Excited to talk to you about stable assets. I saw on the agenda the previous talk was also about stable assets. So it's a popular topic currently. If I repeat some of the points from the previous talk, please bear with me. I was in the waiting room for this talk here, and therefore couldn't listen to the other one. But nevertheless, I'm excited to talk to you about stable assets here. I work on Celo for around 4.5 years now. Today for Celo was a cool day because a governance proposal passed, and with that governance proposal, now Celo supports around 500,000 500 EVM transactions per second. And we have a few things that can scale this number up significantly coming up, novel-based mempool, batch signature verification, move VM. So there are exciting things happening. However, I would like to talk about stable assets since I'm an economist. This is in the end my turf. And for the last 4 or 5 years, I was thinking about the different risk factors of stable assets. And the recent events in these markets made this a very popular topic, and therefore I actually would like to think again a bit about different risk factors with stable asset designs. Why is this currently relevant? And I'm sure everyone in this call or in this has basically maybe a painful memory of the day when Terra started to depack and then very, very quickly spiraled to zero. And in the end, this was something I think many in the industry have talked about, how sustainable a seigniorage design is, what the risks of a seigniorage design are, and what the risks of a seigniorage design are if you combine this with basically inflated demand, inflated with yield projects. I think it's therefore important to think about the different risk factors of different designs, because stable assets in this market are highly relevant. And this is also probably also no news for all of you in this call or in this event here, that the stablecoin market in the past has grown significantly to over 100 billion in market cap, 5 trillion in annual transaction volume. And most of this transaction volume is actually currently coming from trading, from DeFi, from liquidity management. Therefore, I think the topic of stablecoins is in a DeFi event, in this DeFi discussions event, highly relevant, because DeFi in the event is driving a lot of the demand of stable assets. I work on Mento. Mento is an Esperanto word for mint, and it's the name of the stability platform that currently lives on Celo. So Mento, I will talk a bit about the stability design of Mento later in this talk. But I also would like to talk a bit about other stability designs that are out there. There are a few common stories of stable assets in this market. So first of all, most stable coins are actually dollar-based. And this is probably for several reasons. Probably because in the past, the dollar environment or the US has been an interest rate positive area, and in Europe, for example, we have negative interest rates for quite some time, even though we are now entering a rising interest rate environment. With negative interest rates, an issuer of a fiat-backed stablecoin obviously would have to pay interest on the collateral of the stablecoin, and therefore we don't see a lot of fiat-backed stables outside the US. A second common story of the stable assets that we currently see in this market is that many of them had actually periods of DPEGs, either positive or negative DPEGs. All of them at some point traded away from one, and therefore I think also because of that, it's worthwhile to look a bit deeper into the different designs of stable assets. I think some of the stable assets have risks that are frequently discussed. I think in terms of Tether, it's the biggest stable coin out there. A frequently discussed risk there is that there is some unclarity about the collateral of Tether. It lacks basically in the end audit and documentation. And therefore, people here and there are sometimes worried about the design of Tether. And about the UST story, I already talked, and therefore I actually would like to look at the different designs from a risk perspective, basically looking into these different stable coins that we today can find on the market. I think Tether and USDC in terms of governance are clearly centralized stablecoins. There's a centralized entity that governs the stablecoin, and there's also a centralized entity that governs the collateral of the stablecoin. A centralized entity always has some counterparty risk, and therefore this is one of the major risks that fiat-backed stablecoins have: counterparty risk, but also liquidity risk, price risk, duration risk. And one risk that is common to all other stablecoin designs out there is in the end the demand risk. I will talk a bit more about duration and demand risk in a minute, but I think, for example, the counterparty and price risk in the end is just the risk that the counterparty that is holding the collateral for a fiat-backed stablecoin is not able to basically, defaults on requests to pay out the collateral. Therefore, the transparency of these fiat-backed type of stability mechanisms is less than many other more decentralized mechanisms, because in the end, these mechanisms require audits. And many of the audits are also not really transparent. So as a user, I don't know a lot about the entity that is auditing. I don't know a lot about the evaluation method of the counterparty risk that this audit company is using. And therefore, we saw a lot of different stablecoin designs coming up that are more decentralized. For example, DAI as a stablecoin on Ethereum is obviously a decentralized and much more transparent stablecoin. It is the coolest feature here is it is very transparent. Everyone basically can see how the DAI mechanism works, and also everyone can put up collateral and in the form of crypto and create DAI into existence. Here, the main risk in the end are both coming from a demand side and also from a volatility of the crypto that is held in collateral. This is also true for seniorage type of mechanisms, like, for example, Terra. And I think in the Terra case, one of the biggest problems was that Terra didn't have any outside value in its stability design. So basically, once the stablecoin started to depeg, the collateral asset could be minted indefinitely, and with this also the seniorage asset could spiral. What we've built with Mento could be seen as a hybrid between a crypto-backed stablecoin that includes outside collateral. With Mento, we have a reserve that is fully based on crypto, and therefore it is fully decentralized and also fully transparent. People can see publicly what is in that reserve. And having outside value in that reserve means there's also Bitcoin and ETH and also DAI and other stable coins in that reserve collateralizing the stable assets. And the cool thing about Mento is it has different currencies, because I think when in future demand for these digital assets also will come from traditional markets, having different currencies is critical. I listed a few risks, for example, a demand risk. I also listed a duration risk, and would actually like to talk a bit more about what these risks mean. The demand risk I listed as a risk in the end is basically a story that if you want to keep a stablecoin actually stable, then demand and supply should always meet. And in the end, the supply of the stablecoin should always match varying levels of demand. If you look at this from like a very basic economic perspective, if you look here at the chart where the green line and the blue line meet, this is the case where we would have an example of a stability platform that offers 20 million in stable assets. And the demand for the stable assets is exactly 20 million at the price of $1. And therefore, in this case, demand and supply meet at the price of $1, and therefore we are actually packed with the stable coin if it's a dollar-based stable coin. If the platform or the protocol only offers 19 million in the same with the same demand function, then actually we would already see a depack because there's quickly just basically less supply in this market than demand at $1, and therefore we would see a depack. And this is a demand risk. And there are several ways to address this demand risk. With Mentor, we have a mechanism that constantly allows that users can adjust the supply of stablecoin based on varying levels of demand. Demand can change very quickly, and therefore there should be a constant feature in a sustainable, stable platform that adjusts supply to demand. And a second risk I would like to talk about in this quick talk is actually a risk that is not often looked at, but is becoming more and more relevant. For fiat-backed stablecoins, it could be that they hold actually not only cash, but they could also hold bonds in the collateral. And duration for a fixed coupon bonds is in the end an average maturity of all bond payments, where each payment is weighted by its value. And in the fixed income market, this measure, duration, is essential for risk management because it measures in the end the sensitivity of the asset price of this bond to movement in yields. So if, for example, as you can see in this graph, if yields go up, if interest rate goes up, then the bond price should go down. And this is a real risk in the current market environment. We've seen in the past weeks that both in Europe and in the US, the central banks increased the interest rates significantly. And therefore, stable coins, fiat-backed stable coins that hold government bonds or corporate bonds as collateral lose in the end on their collateral in terms of price because they have a positive duration risk in the portfolio. And therefore, when looking into also these fiat-backed stable coins, this is a risk that people have. Mentor, as a stability platform, is, as I said, a combination of two stability features. It is an open source stability protocol that interacts with an over-collateralized and a diversified reserve that also includes outside value, and that has a mechanism that constantly allows users to exchange stablecoins for collateral. So you could, for example, constantly exchange a dollar-based stablecoin for $1 worth of collateral and a euro-based stablecoin for €1 worth of collateral. And therefore, there's some diversification because maybe not all currencies that are supported by this platform are exchanged at the same time. Maybe the dollar and the euro follow different demands or different demand functions. And it also has a diversification in the reserve since it uses different reserve assets. Mento lives on Celo. Theoretically, as a layer 2 platform, it could live on any layer 1. And the cool thing here is, as I said, it supports different currencies. And for us to design a even better Mento or a sustainable stable asset platform, we identified some goals for the future Mento that we are now currently working on. One is, as a goal, obviously, that we have to improve long-term stability and we have to model black swan events, because black swan events, we've seen them in significant number over the last weeks. We had the Terra crash, we had a rising rates environment that is a problem for any risky assets, and therefore we need to design a stability platform that is fully robust. And therefore it's cool that so far the Mento stable assets are relatively stable in this environment. But we also would like to build out more participatory functions and improve the democratization of arbitrage profits. One part of the stability design is that there's an arbitrage feature. You could constantly arbitrage the stable coins. If you find them trading away from one at a centralized exchange, you can always basically go to this on-chain mechanism and do an arbitrage trade. And with these new features, we also want to support better and sustainable growth. We want to decentralize the reserve more. And we want also support for natural capital reserve assets. Why is natural capital cool for a stablecoin design? For two reasons. First of all, having tokenized real assets, natural capital in a reserve, provides diversification for these reserve assets, because tokenized carbon credit or tokenized trees or tokenized clean air or clean water typically should follow a different price function or different risk factors than, for example, the Bitcoin in the reserve. And therefore, it would add diversification to the reserve. But the second nice feature here is that the demand or growing demand for stable assets would lead to a growing reserve. And with a growing reserve, you also have a growing demand for natural capital assets. And therefore, a stablecoin design that includes these natural capital in its reserve actually acts like a carbon sink. If the Mento community is successful to create a lot of demand for the stable assets, then the reserve grows, and with it also the amount of natural capital in the reserve. And therefore, we would like to increase these assets in the common version of Mento. There are a few other features that we added. We made it much easier that the community can actually propose the creation of a new stable token. And we also made it in a way that basically this just requires one proposal and it goes relatively quick to add a new stable currency. Because in the end, the goal would be to have one stable asset for every country in the world. If we want to get real demand, sticky demand, end user demand into this like digital markets of assets, I think here here you need local currencies because maybe end users don't only want dollar-denominated stable assets. We are also currently working a lot on the Oracle design. In the end, in Mento, it's basically a combination of Oracle updates and a Uniswap type of constant product design that allows you to interact with the reserve and mint and redeem stablecoins. And here we've made this also in the past more efficiently. We also have a public roadmap.
So we're at 1 minute.
Yep, cool. We also have a public roadmap of new features we would like to add. We also add a CDP or IRP-like feature that also allows you, next to the constant buying and selling, to borrow stablecoins into existence. And we also work on several features that make the stablecoins more participatory so that, for example, users can also basically help with stability and also help with liquidity of these stable assets. it would be cool if you're interested in stability, in different designs and the different effects of the designs of stablecoins. If you would join the Mento Discord under chat.mento.org. In this Discord, we are constantly discussing topics around stability and around design features of stablecoin platforms. So if you're interested in that, feel free to join us here. We're always happy to talk about these. I've also included my Telegram handle here. If there are any questions, follow-ups, I'm happy to chat. Thanks a lot for dialing in. I really like the DeFi discussions. It's really cool what you're doing. So thanks a lot.
Yeah, of course. We're going to transition to the next session now. Thanks again.
Thank you.